Hi folks, it's Stratman here from pipware.com. This is a lesson, I guess, in a way, just carrying on from my very first lesson I did, which was about moving averages and trading with the trend. Now, we're going to investigate this a little bit further and see where our best opportunities are to buy and sell. At the moment, we're looking at an M15 chart. It's pretty obvious that if we bought at this point, or this point, or this point, or this point, we would have made money on this upward move here. If we sold on all these points coming down here, we would be making money as well. This point here is probably a time to stand aside. So, because it's not really trending, it's not going to give us good high opportunity to make serious money off it. So how can we determine the best points to buy and sell based on this and keep our stops as small as possible? Well, the easiest way is to follow the trend. Now you go to any time frame and you'll see that there is some underlying trend. So here, if you just stuck to the rule that because this is going upwards, I'm not going to do any selling at all. It's all buys. You would make money as long as you didn't buy on the highs here. So the whole idea is to buy on the lows on each part of this move up. That is the secret to making money. And then this move down, you buy on the you sell on the highs. So you sell on this point to keep your stop small. Now you need a way to determine where those highs are and where these lows are. That's where a moving average comes in. It can help you do that. Same here. Sell, 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 sell. Buy, 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 buy. Sell, sell, sell. It's everywhere. This one here, well, what are you going to do here? It's ranging a bit here, but the underlying trend is upwards. So if you had a bought on the dips here, you would have been fine, and then sold on the peaks here, you'd be fine as well. And now we might be buying on a dip here. So that's the fundamental idea behind this whole thing. So we need a kind of a guide here to let us know when we should be buying and selling. Now that's what a moving average is good for. So let's add a moving average. So under indicators, trend, moving averages. Now I'm just going to chuck in 21 exponential moving average close. You could use whatever moving average you like. But what you want is a moving average that kind of follows price action so that you see prices bouncing off it. So we could refine this one a little bit more so that we see prices bouncing off it. Now, depending on what time frame you're on, you've got to decide on what the best moving average is for you. So down on the M5, down on the M1, well, I mean, price is just all over the place. I wouldn't even bother trading this here at the moment. Now this is where the moving average is good. No matter which one you try, there's all your selling opportunities every time price comes up to your moving average. The moving average is telling you selling, selling, selling. At this point the moving average is going flat, but now it's going downwards, so we're selling, selling, selling. You'd even sell here, but it wouldn't go that far, but you're doing the right thing. Then up here, we're not going to buy on the cross of the moving average because we can see that price does come up and spike through our moving average quite often. We're interested in the direction of the moving average when it crosses. So at this point here, it's crossed here, but it's flat. So we're not going to take a trade. At this point here, the moving average is on a slope upwards, and we've been on this side of the moving average. So if there was no price action to the right here, we would be buying at this point. And notice that our stop would be quite small, and we'd probably get stopped out, or we'd make a very small profit. But this is now telling you that, well, it didn't trend upwards, so now you stand aside. So the moving average, in summary, is telling you if it's sloping downwards, selling only when price is on this side of the moving average, and sell when it comes up to the moving average or close to it. Buy only when the trend is upwards. So let's have a look at a trending upwards. Buy only on the dips here as it comes towards your moving average. This point is flat, don't do anything. I wouldn't even have sold at this point. I'd be waiting for it to come back up, kind of like what we call a pullback, and then sell. This is the direction of the trend. We're only doing sales. you might not be able to get into trades very often, but you're getting into high probability trades, and that's what it's all about. Now, so looking at this, if we're trading the 5 minute, we'd be standing aside all this time here. We'd be waiting for another opportunity like this. On the M15, we're standing aside. It's flat here. There's no reason to trade. Okay? So we might change the value of our moving average. We could slacken it off a bit just to catch some of these peaks properly. So this is what I would do. I'd come in here and I'd go, well, the period of my moving average, I'll make it a bit longer. Let's just try 30. What does that do to our moving average? Well, it's caused it to flatten out a bit, and it means that when price came back, my stops would be a lot smaller. So if I look at how much that stop would have been if I had got on there, I'm only talking about a 10 pip stop. So this whole thing of moving averages is fantastic. Now, once you've chosen what moving average you're going to use, you should add a second moving average that's from a higher time frame. If you're on the M15, and this is where the 3 duck strategy ideas came in and clicked with me, was the idea of using the same moving average on a time frame that's higher. So I'm going to look to my H1 time frame. I always skip the M30, just a personal preference. And I'm going to take the H1 time frame and think to myself, well, what would an H1 time frame this moving average look? Because if I add this moving average here to this time frame here, I'll have a slower moving average here that's telling me what's going on the H1. So we chose, at the moment we're using a 30 period. So what would this 30 period moving average look like on the M15? Well, the M15, 15 minutes fits into 1 hour 4 times. So the moving average period for this to look the same on the M15 would have to be 4 times 30 is a moving average of 120. So let's add in our 120 moving average. So we're just doing the same thing, and there's our second moving average. And so now what we're doing is we're seeing what's going on the higher time frame. So one of my rules is that when I've got this kind of thing showing up, I have a look and I go, well, there's all my opportunities to trade. They're all there bouncing off those moving averages. So if I was on the H1, there's where price is touching there. So I wouldn't be looking at selling just because it's below this slower moving average. I'd possibly still be looking at buying. So one of the techniques I use is to, unless this is for less experienced people, is that if price enters in between the 2 moving averages, that's considered to mean no man's land. You know, it's kind of like the old war kind of thing. No man's land is the place where no one goes because they're between the enemies and they get shot. So we wouldn't be trading any of this stuff in here. We wouldn't be trading any of this stuff in here. No way. But what we are interested in doing is trading the high probability trades that are with this trend. So price comes down, touches here, we're going to buy. What would our stop be? Our stop would be quite small in both these cases, 10 pips, 7 pips. I mean, you see the idea. This one here, you know, the stop would be virtually nothing. And look how so that would be a very small drawdown, and we could have made nearly 50 pips out of that. So I think you get the idea. Now the problem is if I move out to another time frame, these stay at the same values, which is the 120 and so on. So if I was down on the M5, I'm really after the one on the M15 to be my longer time frame one, higher time frame. That's not going to work for me in this case just by having 2 moving averages, because this one here really needs to be, because it's 3 times to get into the M15, which is what I'm interested in, so it needs to be a 90 moving average. So this is why I set up the dashboard, and I just made a template today just to show you this exact thing. So if you change time frames, the moving averages will change to the appropriate values for that time frame. Okay, folks, that's it. We will catch you later.